Hello and welcome to One-to-One Mining Investment. We now have our investment leaders panel, and we've got a fantastic group of panelists for you today to talk us through the current appetite for investment, particularly with the background of the COVID-19 crisis. I'd like to welcome Scott Clements, who is the Managing Director of Canaccord Genuity. He's based down in Singapore. We have Jason Chang, who is the CEO and Managing Director at EMR Capital, a private equity company based here in Hong Kong with also offices down in Australia. And we have Juerg, Kiener, who is Managing Director and CIO at Swiss Asia Capital based in Singapore. So panelists, delighted to see you all here today. Scott, I think if we can start with you, Canaccord Genuity obviously got a sort of offices all around the world and a good sort of feeling of investor appetite at the moment. What's your take? How's your deal pipeline looking, and what's your take on investor appetite for mining investments at the moment?
Yeah, thanks, Leo, and thanks for organizing this. It's amazing how we can keep doing these conferences in the current environment, and and easier in some ways. We don't have to travel and just hook up. So anyway, it's great you guys are keeping on with these events. I guess what I mainly do in Asia is help raise capital in the region for primarily North American companies, but I mean it's really the same across the board that we've had this huge panic sell-off in the broad market in March, and then this incredible recovery since then that I think has gone further than most people really thought it would, and keeps going. And so for us, we've been amazingly active in terms of raising capital, and it started in March, where you had companies that just needed to raise money and were willing to do it at a pretty deep discount, and came to the market, found some investors, and those investors typically did quite well on those early deals, and then it just kept going. And so we've had a huge pipeline. Certainly in the mining space, we've been very active. We've globally, I mean, the Australian market in particular has been hugely active, but it's across the board in other geographies as well. And really, I guess gold has been the preferred commodity from an investor perspective. It's the one commodity that I think everybody can agree with. We saw a sell-off in gold in March, which was this sort of correlation of one trade where everything was getting liquidated, and gold didn't particularly act the way it was supposed to at the time as a portfolio diversifier. But I think people understood why that happened and quickly wanted to get back in the market when the recovery started. So we've been doing a large number of gold transactions, and it's started off with the larger companies, and it's now migrated down to some of the small explorers. So it's a pretty broad and deep rally, and with generalist investors and smaller retail investors and traditional resource and gold investors. So it's been quite broad-based. So we have seen interest in other commodities as well, but gold has really been driving the bus from a mining capital raising perspective.
You mentioned that some of those earlier deals were at quite a big discount. Probably miners wanting to sort of get some cash in to keep the lights on. As we've moved forward, obviously the discounts are smaller now, and as the miners regain confidence and start developing their projects and stuff. Is that correct?
Yeah, absolutely. But I think you still need to make it interesting for investors, and we're in this environment where there's a bit of a disconnect between the real economy and the markets, and it's this sort of tug of war between central banks and what's happening in the real economy. The central banks have definitely been winning so far, but I think people are still a little bit skeptical of markets, so they're not willing to pay up too much. So, for example, we raised just under $200 million on Monday night for Osisko Mining in Canada, and that was a unit deal. So shares plus some warrant exposure, and that was all in a 9% discount as an example for the full package. So, you can't do deals flat, but certainly the early days of big discount issuance are past for the time being, largely.
Are there, I mean, you mentioned gold, obviously. Are there any commodities which are struggling to raise money at the moment that people see as a big risk?
Yeah, I don't know if this is a oil and gas panel as well, but that's a pretty tough market. Yeah, I think across the board, base metals are tougher, but a lot of times in these cycles we see first gold rallies and then silver and then copper. So I think people are getting a little more constructive on some base metals like copper. I'm not an expert on bulk stuff, but iron ore has had has been pretty solid performer through the tough times of the market in the last few months. I think a sector that's still a bit tough is battery materials, because I think people still like that theme longer term, but it's been such a dislocated market short term. I think it's a bit harder to get people to get their heads around it from an investment perspective.
Although there's been some positive news coming out recently about battery materials. I believe in Australia, I saw some figures the other day showing that wind and solar backed up by large battery backup systems is actually now cheaper than coal-fired power, which is sort of an interesting dynamic, interesting turning point, possibly.
Yeah. No, that's a good point. I think the renewable energy sector, I think the ESG thematic for investing is here to stay, and I think it's performed reasonably well through the sell-off, which has given people some confidence. So you're totally correct. Prices are coming down on alternative sources of energy, and I think people just have trouble in the near term understanding the demand side and supply. We had a big influx of new early stage companies a few years ago, and a lot of those companies have had trouble, and people are trying to understand what the supply side is going to look like in the next year or two.
Sure. Jason, if we could bring you in now. Obviously, EMR Capital, PE company there, investing in a number of major projects around the world in various commodities, copper, potash, gold, I believe. What's your take on the market right now? Are there some of your companies which are doing better, or some of them, slightly struggling? What's your take on the market?
Yeah, thanks, Leo. We are very excited at EMR about mining and mining's future and what we're seeing in the marketplace. In fact, this whole environment, I think, has proven that mining is a very important part of the economy, the global economy. I mean, it's deemed and considered an essential service in, I think, all countries other than a few. So from an operational perspective, we've been operating 24/7 throughout, it hasn't stopped, as you know, Leo. I mean, and Australia obviously has done extremely well. We've got 2/3 of our capital in 4 operations in Australia. So we own and operate 9 operations around the world in 6 countries, and 4 in Australia. But throughout, in all of those countries, US, Chile, UK, Spain, Zambia, and Australia hasn't stopped. So that's one data point. So good news for mining and mining investments. Fortunately, in all our operations, there's been no disruption. We've got a global workforce of about 5,000 people. We've had 6 infections, and everyone's recovered. So I think the mining community, the mining sector has performed very, very well from that perspective in terms of implementing policies and procedures to protect the safety, health, and well-being of all people, all the workforce. So that's gone well. So we focus on 4 commodities, gold, and our shares got enthusiasm. So that's good. We've got copper. It's not of our focus. In fact, we've got 4 of the 9 are in copper, and we've got 1 gold operation we just acquired, Ravenswood Gold in Queensland. you know, signed up pre-COVID, and we completed just about a month and a half ago. That's in Queensland. So we are very excited about it. And then we also have 2 operations in hard coking coal and 2 operations in potash. So from a commodity perspective, gold obviously, as Scott touched on, you know, really very much a lot of interest given the current global risk appetite of investors. Copper came off obviously quite a bit in Q1, but it's slowly graduating upwards. I mean, our long-term view is very positive on copper, as you would appreciate, whether it's you know, electric vehicles or new technology, or even, you know, face masks, Leo. You know that the Hong Kong government has patented, I think, the world first copper face mask. So we are very interested in copper, continue to look at lots of things. And hard coking coal, we are owning and operating Kestrel in Queensland, one of the largest underground longwall mines in Australia. In fact, I believe last year was the largest producer underground longwall. And then we've got a very interesting project in UK. So hard coking coal actually, the price increased, you know, at the start of COVID because of the impact on supply. But suddenly, obviously, you got lockdowns in the major economies, whether it's Japan, Korea, China, or India. So demand in the short term is disrupted. So hard coking coal price, unfortunately, have reduced quite dramatically. But certainly, the long-term view of the brokers and analysts and consensus certainly seems to be more in the region of $140, $150 per ton. That's broadly our view, so that should go extremely well, especially given the stimulus by many countries. And you know, China will continue to grow as India, Indonesia, Southeast Asia, all trying to build a steel industry. So we are still highly positive on that. Potash we see much less traffic. We've got 2 potash projects, one in Utah in US and one in Spain, and all very good projects. And I think the general thesis is potash has a very strong macro dynamic. So we're still very excited about that. But overall, Leo, you know, mining's done well. It's bounced back, and will continue to do well. I think the world understands this is not a structural issue. What we're seeing is a health dynamic, and you know, things will come back. Economies will continue to grow, even though short term there's going to be some disruption. So I think the key takeaway here is that if you're focused on the right commodities, you're going to go very well.
And obviously copper's had a big boost by, you know, being revealed that it has these sort of antiviral properties, and hospitals now looking at using copper for their sort of, you know, key sort of touch surfaces and things like that, as well as these masks that we've got. So some interesting things there. Juerg, if we could bring you in now. We talked a little bit about gold, and I know this is an area that you are interested in. Tell us your thoughts on the outlook for the gold price. You know, obviously it's risen a lot recently with all the disruption, but what about long term, and how does this impact your appetite for investing potentially in mining companies, in gold mining companies?
We are, let's put it that way, very concerned about the financial system globally. We basically had a heart attack in March, and basically both sides of the heart collapsed. The first one was the repo side, which is credit. And the second one is basically the currency collapsed. And you could see that basically with the fight for the euro dollar to survive. So liquidity doesn't solve credit issues. It only solves liquidity problems. So what we are seeing is that actually the central banks are on the deathbed, and they have to redefine how they're going to come out of that mess. So because of that, we are really very positive gold, but we are positive some other commodities, because the commodity sector, the real asset market, is actually the opposite to finance and the financialization of the market. So gold has a very big positioning in our portfolios. It had it since 2000 when we had the financial cross, where gold basically started to outperform financial assets since. And if you look in 2001, I think gold went up about 4 times after the Nasdaq crash. It went up 3 times after the 2008-9 debacle. And I think this time we're going to go up probably at least 4 times from the lows we've seen to have a similar impact on rebalancing in the financial system. So that's from a gold point of view. I think if you want to back the outstanding debt, then the gold price will go much higher than 4 times. But 4 times for me, that's more than good enough. The issue I have, because it's a credit issue, is that liquidity is not available for everybody equal, even if now government's been handing out money to everybody, but we all know that's not going to happen like that. And if you look at the distribution, it's not equal neither. So we are quite risk reverse. We're still looking on high quality assets, high quality management, funded stuff, and cash flow, because I think in that environment, cash flow is king. We don't believe that the debt market will stay at zero, particularly not on the credit side. And that means I need better protection. We think the biggest issue we have in this dislocation is that the world will be changing from a point of view of globalization to deglobalization. It will change from a point accession issue. And if you believe you print all this money, somebody will have to pay for this money. So we believe that taxation and protection of asset ownership becomes a much more important issue when you put a portfolio together. So that means we're getting much more restrictive on which countries we invest in, the stage of the project we invest in. And sometimes there are different ways to actually make money. People always think, oh, large is boring and the small one is exciting, but you know, leverage is almost free. You could actually buy today an option at 50% at 0 additional cost. So if you actually think from that point of view, you could actually buy as a larger company with less production risk for no additional cost in the market. So there are different ways on how you can skin that cat. But basically, we are an opportunistic approach in looking at how we position ourselves. We are very favorable to the silver market. We think the gold-silver ratio is totally out of band in an environment where we had almost 46% of global silver production shutting down. And it's putting a lot of pressure on outstanding derivatives, and that's something nobody talks about. But derivatives are a big issue. We've seen oil trading at negative yields because we had storage issues, and the derivatives really didn't have storage case. In the precious metal universe, we have the opposite structure. We have too much financial engineering and no supply. And in the silver market, it becomes now so tight that we think silver has a very good chance to test the old highs. Whilst gold, even if it goes up, it will not do the same time of return. Longer term, we like the copper space, sulfide nickel, and probably some of the battery minerals as governments will come and find new activities. So infrastructure bill by next year will go ballistic. And I think once Trump is going for election, you're going to see probably huge programs getting rolled out in that field. We are bullish iron ore. We've been sitting in iron ore for a long time. I mean, where do you get basically stocks which are trading at 10 times earnings with 10% dividend yield? I mean, it's unbelievable. And it's a nice little pension fund structure on cash flow. So we are cash flow investors, and in all our universe in investing, that's what we are looking at most. Securing asset, high margin, good return on assets, investments, and ESG compliant companies. And that's where a lot of large companies actually are struggling, meeting the ESG, even if the prospectus and the PowerPoint presentation looks interesting.
Yeah, Rio Tinto had a little issue recently, obviously, with this thing that they accidentally blew up in Western Australia, a cave, making some big mistakes there, I guess. But anyway, moving on from that, you mentioned deglobalization. Are you expecting this to lead to more sort of resource nationalism and, you know, countries trying to find their own supplies, secure their own supplies of, you know, critical minerals? Obviously, many of the critical minerals at the moment are produced by China. Would you expect, you know, countries to be looking to secure their own supplies, and does this create opportunities, do you think, for the mining industry?
I think, you know, as warehouse structures and quality of the product becomes more and more important, you're going to get deglobalization. You're going to see people building larger inventories, corporates which are basically securing investments in producers straight away. They become off-takers, so the metals don't go anymore through the exchanges. And you have in the United States, you have in Europe now funds which are sponsoring actually finding and developing more exposure to the sector, which is required to keep the economy stable. So I think you're going to become much more inward looking for sure, yes.
Absolutely. So looking sort of forward as we start to come out of the crisis, what do you all think is the sort of the longer term impact of this current crisis? What do you think is going to happen next? So if we look forward to 2021, what do you expect to be the big themes?
I think infrastructure is going to be a very big theme. I think new technology, like electric vehicles, but medical field, water supply, water cleansing, pollution, which uses a lot of silver, it's certainly going to be a big issue. So you see a new technology involvement coming out. It's always happened after crisis that we're going to move into new technology. So from that point of view, I think a very big improvement. But the other thing, which I think which we're going to start seeing, is a new financial system. And because the counterparty risk gets too big, how do you keep your reserves? How do you optimize them? How much leverage are you willing to take? Which banks will still be afloat? And that's going to be probably quite disruptive. It's going to impact almost every single investment around the world. And how to value that, I think that's probably the biggest headache we all have.
Scott, is Canaccord preparing for a sort of change in the global financial system? Are you what's your take on how that's going to play out? You as pessimistic as Juerg?
Well, that would be difficult, I think, but he's always got a bit of a bearish stint on the world, which is good for gold for sure. Listen, I think it's the crisis is going to have a big impact on so many different parts of everybody's life that it's hard to envisage now. I think, in terms of infrastructure, which is relevant to commodities, I think it would make total sense for governments to do a 1930s New Deal style big infrastructure build, get people back to work and get the economy moving and increase productivity and all these things. And so that should be what happens. The only thing I don't know is it's difficult for politicians to spend a lot of money and push these things where you don't see any benefits within a 4-year election cycle. You have all the inconvenience and problems in the near term, and it doesn't really pay off till later. And I think that's why we didn't see a lot of this happening after the 2008 financial crisis, even though everyone was talking about infrastructure projects, because politically it's not that expedient for your near-term election issues. So I would hope that happens, and it should happen. I just have that nagging question whether it actually will happen. The whole argument for having some gold exposure in your portfolio is that we just have this crazy, unprecedented level of central bank support and printing money, but you're not really printing money. You're raising debt here, and then you're putting it into this pocket, and it's magically okay. And nobody really understands what that means over the long term, and hence gold is the only real store of value that's withstood hundreds of years of cycles and trials and tests that people can point to, and like Bitcoin or anything else can't really say that. So I think the long-term argument for gold is pretty strong, and there's different ways that you can invest in it, but from physical or ETFs or mining companies or royalty streaming companies or things like that. But that's one commodity that I think it's not a sure bet, but I think it's more sure than most things you could invest in the commodity space.
So in terms of sort of predictions for the gold price, maybe by the end of the year, Juerg suggested that we'll be looking at sort of 4 times gold price. But I guess Juerg, your prediction was based on sort of unraveling of international sort of financial markets. How how likely do you think that is to happen?
No, look, we can keep the Dow wherever it is, right? We print so much money that we can keep the market basically up. But the money printing appears in the balance sheet of the banks. And if you actually look at that, when you look at balance sheet expansion, that happened after Nasdaq crisis in a small little blip, right? We spent basically about $1 trillion. If you look in 2008, it was $4 trillion. And I think this round is going to be between 12 and $16 trillion. So if you start looking at the maths, right, it's each time about times 4. So if you actually then believe that the asset base will have to revalue versus that, and we can discuss which assets will have to revalue versus that. That's going to be the more harder thing, but gold is basically reacting on the back of that. So which assets will go up and down is another issue. And if the government controls 70 or 80% of all the investments into the market, they dictate the price. So I'm not telling you the market will have to unravel, because 0 times 0 times 0 cost means I can fix the price. But there's going to be something which they can't fix, and it's their balance sheet. And the only thing on the balance sheet they can revalue to have a balance sheet which is still meaningful is gold. And that's why gold normally re-rates. So am I gloomy that everything is going to collapse? Probably not. It's going to be a lot of people which have pain, yes. Is everybody going to survive that mess? I don't think so. Are we going to rebuild? Yes. What are going to be the beneficiaries and where are they going to be? I think that's the question everybody would like to know. I don't have that answer. But I think gold from a monetary point of view is finding its way back in the monetary system. And as it finds that, because the Bank of International Settlement claimed it's now 100% collateralized asset on their balance sheet, will mean that it becomes attractive. And that means that the people who are short in the market are desperately trying to get out. And that's pushing prices up and builds a new trend. And this trend is going to get played. I don't know how long it's going to get played and how fast it's going to get played, but it's probably an up market cycle. And so when people say I'm bearish the rest of the world, how can you be bearish if you give everybody free money? You can't, right? The question is, who's going to pay for it down the road?
When we came out of the 2008 financial crisis, obviously China played a big role. The amount of infrastructure that was, done in China in the years following that was a real key driver for the mining industry. What is China's capacity, and also with the background of possibly the trade war between America and China being worsened by this COVID crisis? To what extent will China be able to, drive infrastructure builds as we come out of this crisis? Jason, obviously, you're here in Hong Kong, got a close eye on the mainland. What's your take on what's going to happen regarding China and the trade war?
Look, I think despite whatever's happening around the world and despite the trade war, I mean, China's growth, I think, will continue to be very impressive. I mean, whether it's going to be 1% this year or 3%, and next year is 5% or 7%, they're all big numbers of 13, 14 trillion today, right? So I have confidence in the Chinese government being able to manage that quite well. They have a good track record and they've been able to act very, very fast. So I think notwithstanding all of the current disruptions, I think China will still be a major contributor to the global economy. But I do share the view that there is going to be, a slight pause in terms of, a slight slowdown, I would say, in terms of globalization as governments now reflect on, their own domestic situation. There's going to be more regulation. I mean, we've seen that across the world, right? Whether it's Australia or elsewhere, there's going to be a bit more regulation in the short term. But I'm not anxious about that, because ultimately, the world's still going to be driven primarily, I think, by market forces. So I'm more on the optimistic side, Leo, and I think China will be an important contributor, as will India, when they come out of the lockdown, and you'll see the growth there continue. And I mean, at Kestrel, a lot of our coal goes to India. They've been a major client and customer, and they were the biggest importers of that. And we have a very positive view on hard coking coal, as in copper. I also share the view on gold. So this part of the the world, this time zone, I think will be continue to be I think the biggest contributor to global growth, and I don't think that's going to stop.
Well, I think that's probably quite a good place to end it. Obviously, mining companies and mining investors, it's a long-term business we're in here, and so if you stay off the distractions of Twitter and people wanting an instant bounce or an instant crisis or whatever, if we look on the long term, lots of opportunities on the horizon, and a bigger picture perspective probably helps, would help everyone at the moment. But thank you very much all for joining us here today, and look forward to seeing you at a live event in the near future. Thanks.
Thank you.
Thanks, Leo.
Thanks, Leo.